Welcome back, RMJ. Ready to jump back into this goodwill calculation? It's like a puzzle where we piece together what we paid versus what we actually got. Since we're picking up where we left off, do you want to walk through the calculation step by step from the top? Or is there a specific part of the consideration or net assets that's tripping you up? All right, let's get into the nitty gritty. First thing we always do is map out the group structure so we know who owns what. In your notes, it shows X acquired 300,000 of Y's 400,000 shares. That 75% is our parent stake. Now, the big formula for goodwill is what we paid plus what the outsiders own, minus the fair value of the business we bought. Let's start with the consideration, which is just accounting speak for the price tag. First part is the cash. That 250,000 comes straight from the problem text where it says cash payable at acquisition. Simple enough, right? But then it gets spicy. X also issued new shares. The notes say a 1-for-3 basis. Do you want to try calculating how many shares X actually issued based on that 1-for-3 rule? Ah, I see what you're thinking. Decimals and percentages are just two ways of saying the same thing. Mathematically, 0.75 is exactly the same as 75%. In accounting, we usually talk in percentages to describe the ownership stake, but when you're doing the math in your calculator, you'll definitely use 0.75. So, looking back at that 1-for-3 share deal, if X bought 300,000 shares and issued one new share for every 3 they bought, how many shares did they give away? Not quite 75. Remember, the 1-for-3 deal is based on the number of shares X acquired. The problem says X bought 300,000 shares. If you take those 300,000 shares and divide them by 3, what do you get for the total number of new shares issued? Spot on! 100,000 new shares. But we can't just put a number of shares into our money calculation. We need to know what those shares are worth in dollars. The notes say the price of X's shares on that day was $7.35. So, adding the cash and the shares together gives us a total consideration of $985,000. This is the total value X gave up to get control. Now, there's one more piece to the what we paid puzzle, the non-controlling interest, or NCI. These are the other shareholders who own the remaining 25%. The problem explicitly tells us the fair value of the NCI at that date. Can you spot that number in the text? You got it. Here is the big master equation we are building toward. Think of it like this. The first half in the parentheses is the total value of the whole company. And then we subtract the actual value of the assets we got. I've written down that 280,000 for the NCI. It's just given to us in the problem text. So, combined, The total value being attributed to Y is $1,265,000. Next up is step 3. What did we actually get for all that money? We need to look at the fair value of net assets. In your notes, they list 3 things here: share capital, retained earnings, and a fair value adjustment. Check the first page of your notes. What was the amount for Y's retained earnings on the acquisition date? Yep, 500,000. That's the profit Y had already made before X showed up. The share capital is 400,000. That comes from the very first line of the problem where it says Y has 400,000 $1 ordinary shares. Now, here's the tricky part. The notes mention a fair value adjustment for land and buildings. It says the fair value was 160,000, but the carrying amount, which is just the value on the books, was only 100,000. If the real value is higher than what's on the books, we need to add that extra value in. How much extra value do we have there? Wait, 900,000? Let's take another look at those 2 specific numbers for the land and buildings. We have the fair value at 160,000 and the book value at 100,000. The adjustment is just the difference between these two. If you subtract 100,000 from 160,000, what's left over? Right, 60,000. That's the hidden value that wasn't recorded in the regular accounting books. Now we have all our ingredients. We just add those 3 up to get 960,000 for the total net assets.
Nigger.
We're at the finish line. Remember our big equation? We take the total value we found in step 2 and subtract the net assets we just found. If you do that subtraction, what total do you get for the goodwill? Boom, 305,000. That is the exact figure in your notes. This basically means X paid $305,000 extra for things like Y's brand name, reputation, or staff. Stuff you can't see on a balance sheet. Before we wrap up with your summary and flashcards, does that step-by-step logic feel solid to you? Let me walk you through exactly where these numbers are hiding in your notes so you can find them every time. First, for ownership, we grabbed 300,000 and 400,000 from the first line of activity 3. Second, for the share value, we used that one for 3 ratio and the price of $7.35 found under the purchase consideration section. Third, the fair value adjustment of 60,000 came from the difference between the land's fair value of 160,000 and its carrying amount of 100,000. Fourth, for net assets, we got the share capital from the 400,000 shares at $1 each, and the 500,000 for retained earnings was explicitly stated as the amount on January 1st. Finally, we plugged everything into our master formula. Does seeing the sources mapped out like this help clarify where the math starts? Awesome. You really crushed that calculation. Here's a quick summary of the big traps to avoid, like making sure you use the fair value of the assets, not just the book value. I've dropped those flashcards on the board for your revision. You feel ready to tackle another one like this? Or is there anything else on your mind? Lesson over. You totally nailed the logic behind those goodwill steps today.